You only get one shot at retiring the right way. Start your RRSP or RRIF withdrawals too early, and you might pay more tax than you need to. Start too late, and you can trigger higher tax brackets, OAS clawbacks, and even a huge tax bill on your estate. In this video, I'll walk you through how to find your best time to start withdrawing from your RRSP or RRIF with real-life style case studies so you can see how this plays out in the real world. Roadmap. Here's what we'll cover. RRIF in plain language. The age 71-72 rules and RRIF minimums you can't ignore. How timing affects your tax bracket and OAS clawback. 3 real-life style withdrawal timing cases. A step-by-step checklist to decide when you should start. Grab a pen or take screenshots. This is the stuff that can save you thousands over your retirement. What changes at 71? Let's start simple. An RRSP is mainly a saving and contribution account. You put money in, get a tax deduction, and your investments grow tax-deferred. A RRIF is the paycheck version of that account. You convert your RRSP to a RRIF and start taking income out. Every dollar you withdraw is taxable as regular income. You must convert your RRSP to a RRIF or an annuity by December 31st of the year you turn 71, and then RRIF minimum withdrawals start the following year. That's when the government essentially says, it's time to start paying tax on this money. RRIF minimums are based on age. At 71, the minimum is about 5.28% of your RRIF value. At 72, it rises to 5.4%, and it keeps increasing as you get older. So a $500,000 RRIF at 71 forces out around $26,400 of taxable income, whether you need it or not. Before conversion, RRSP lump sum withdrawals face withholding tax. Generally 10% up to $5,000, 20% from $5,001 to $15,000, and 30% above $15,000 for Canadian residents outside Quebec, which is just a prepayment of your final tax bill. So why timing your withdrawals matters? RRSP and RRIF withdrawals are taxed at your marginal rate, the tax rate on your next dollar of income, not your average. That means the timing of withdrawals relative to your other income is critical. For example, add a big RRSP withdrawal on top of $60,000 of employment or pension income, and you might push yourself into a higher federal bracket and higher provincial tax, plus risk losing income-tested benefits. Strategically plan and make that same withdrawal in a low-income year, and the tax bite can be much smaller. On top of regular tax, once your net income crosses the OAS recovery threshold, about $90,997 for 2024 and $93,454 for 2025, the government claws back 15 cents of your old age security for every extra dollar of income. That effectively adds 15% to your marginal tax rate in that income band. So the best time to withdraw is rarely as late as possible. It's usually when your overall tax rate and benefit clawbacks are lowest over your lifetime, which often means smoothing income across years. Next, let's discuss the important age milestones and key rules. Let's quickly hit the milestones that matter. Up to age 71, you can contribute to an RRSP until December 31st of the year you turn 71, assuming you have contribution room. RRSP withdrawals before conversion are fully taxable and subject to withholding tax, but there are no minimums. By December 31st of the year you turn 71, you must convert your RRSP to a RRIF, buy an annuity, or cash it out, which almost always triggers a huge tax bill. From age 72 onward, RRIF minimum withdrawals start based on government-set percentages. At 71, the minimum is 5.28%, at 72, it's 5%, 73 is 5.53%, and it keeps rising through your 70s and 80s. These minimums are calculated on the previous December 31st balance and must be withdrawn during the year. Miss the minimum, and you can face reassessments and potential penalties. Take more than the minimum, and that extra will usually have withholding tax applied and can impact OAS, GIS, and provincial credits. Now let's look at a real-life example. Early 60s gap years, the gap years strategy. Chris, age 61, is retiring this year. Has CPP and OAS starting at 65, if taken at 65. $450,000. TFS, $80,000. No defined benefit pension. If Chris does nothing, here's what happens. Ages 61 to 64, low income, mostly living off savings. At 65, CPP and OAS kick in and push his taxable income up. At 71, 72, minimums on a still large RRSP get piled on top of CPP and OAS. That can mean low tax bills in his early 60s, but higher brackets and possible OAS clawback later, exactly when RRIF minimums ramp up. Smarter approach: start modest withdrawals now. Instead, we intentionally start withdrawals in the gap years between retirement and full government benefits. Ages 61-64. Withdraw, for example, $20,000 to $25,000 per year from the RRSP while his other income is low. Use that to fund living expenses and top up his TFSA. This keeps him in relatively low tax brackets and gradually reduces the RRSP balance before mandatory RIF minimums kick in. At 60, an OAS start. Because the RRSP is now smaller, future RF minimums will be lower, reducing the risk of hitting OAS clawback in his 70s. At 71-70, RIF minimums are based on a smaller starting balance, which means less forced taxable income every year. In other words, Chris uses his early 60s to prepay some tax at lower rates instead of being forced to pay at higher rates later when OAS is on the line. Let's take a look at another example. Couple and income splitting, two spouses, uneven income. Janet, age 66, and Mark, 67, both retired in Ontario. Mark has a $25,000 annual pension. Combined RSPs, $700,000. TFSA balances, $100,000 combined. Both eligible for CP and OAS. Their objective: keep total household tax low and avoid OAS clawback once ARF minimums start. Here's the strategy. Convert part of the RRSPs to RRFs in their mid-60s. They don't need to convert everything at once. Instead, they do partial RSP to REF transfers and start smaller, planned RF withdrawals. Use pension income splitting. Once they have eligible pension RRIF income, often after age 65, they can split up to 50% of that income on their tax returns, so one spouse isn't pushed into higher brackets while the other is in a lower bracket. Coordinate with CPP and OAS timing. They might delay CPP or OAS slightly for one spouse or start earlier for the spouse with lower RIF balances, depending on projections. The target is to keep each spouse's income steady and below the OAS clawback threshold rather than having big spikes in any single year. Use the TSA as a buffer. If 1 year's income is set to be higher, maybe due to a one-time RIF top-up or unexpected expense, they draw extra from TFSA instead of RIF to avoid crossing the clawback threshold. Result: by coordinating early RIF withdrawals, splitting eligible pension income, and using TFSAs to manage spikes, Janet and Mark smooth their combined income, reduce lifetime tax, and protect their OAS. Here's another real-life case: late 70s and estate impact. Age 78, 650. TF 60,000. Non-registered investments, $120,000. Widowed, 2 adult children, both independent. At 78, Nora's RIF minimum factor is around 6.36%, so she must withdraw about $41,340 this year, fully taxable. She doesn't need all of that for spending, and she's worried about tax at death. Key considerations: OAS clawback and benefits. Her RIF minimum, CPP and OAS together, might put her close to or over the OAS clawback threshold, dramatically increasing her effective tax rate on extra withdrawals. If Nora dies with $650,000 still in her RRIF and no spouse, that amount is generally included in her final tax return as income, often taxed at the highest marginal rates for that year. Here's the strategy. She can choose to withdraw only the mandatory minimum each year if extra withdrawals would just stack on at high marginal rates and cause more OAS clawback. However, if projections show future balances staying high, Nora might deliberately start drawing a bit more than the minimum in years where her taxable income is lower and shift some of that money to her TFSA or non-registered accounts, depending on her capacity. She reviews beneficiary designations so her RIF passes directly to her children as beneficiaries, though tax still hits her final return, and she considers insurance or other planning strategies if she wants to offset that eventual tax bill. For someone already in their late 70s, the best time is often less about starting withdrawals and more about fine-tuning, not taking unnecessary extra RRIF income that just triggers clawback, but also not ignoring the estate tax story. Now let's review some practical setup and logistics. When you're actually ready to act, here's how the mechanics work. Converting to a RRIF, you instruct your financial institution to transfer your RRSP to a RRIF, ideally as a direct transfer so you don't trigger tax at that moment. You choose payment frequency, monthly, quarterly, annually. The institution will ensure you at least meet the minimum each year. Withholding tax, RRSP lump sum withdrawals have withholding at 10, 20, 30%, depending on the amount. RRIF minimum payments typically have no mandatory withholding, but any amount above the minimum usually does. You can also request extra withholding if you prefer not to owe at tax time. You'll receive T4 RSP T4 IF slips each year for withdrawals, which you must report on your tax return. This is why big, one-time RRSP withdrawals without planning are dangerous. They attract withholding up front and can still leave you with a bigger tax bill when you file. Finally, a best time to start checklist. Here's a simple checklist you can put on screen or in your description. Map your income by age. Estimate employment income, CPP, QPP, OAS, pensions, RSP, RIF, and investment income for each age from now through your 70s. Identify low-income windows. Look for years between retirement and age 71 where your taxable income will be lower. Those are prime years to start moderate RRSP DEF withdrawals. Watch the OAS clawback line. Note the OAS threshold, for example, about $90,997 in 2024 and $93,454 in 2025, and aim to keep your income just under or in a controlled zone around it, unless there's a good reason to go higher. Decide your starting age. If you'll have low income in your early 60s, consider starting modest RRSP withdrawals then. If your income stays high into your late 60s, you may delay, but accept that RRIF minimums will likely be bigger later. Use splitting. If you have a spouse, use spousal accounts and pension income splitting to even out incomes. Use TFSA withdrawals to cover spending in years when taking extra RRIF income would shove you into higher brackets or clawback. Review estate impact and beneficiaries. Check your beneficiary designations on RRSP, RRIF accounts, and estimate the tax bill if you died with current projections. Adjust your withdrawal plan or insurance accordingly. So there's no magic best age that works for everyone. The best time to start withdrawing from your RRSP or RRIF is when you can move money out at reasonable tax rates without triggering unnecessary OAS clawbacks and without leaving a massive, heavily taxed balance to your estate. If you want a follow-up video where I plug real numbers into a simple projection tool and compare starting at 60, 65, and 71 side by side, drop your age range, province, and RRSP RIF size in the comments, and I'll build examples that look like your situation. And if this helped, hit like, subscribe, and share it with someone who's sitting on a big RRSP and has no idea when to start taking money out.